Graphex Mining has announced the execution of a non-binding term sheet for a 50% equity joint venture agreement with a Chinese syndicate, as well as offtake terms for 50% of the project's production. This has resulted in an updated valuation for Graphex of $1.61 per share. The increase to our valuation was due to a reduction in our discount rate assumption, as well as adjusting our debt and equity assumptions in line with the term sheet. This is an excellent achievement for Graphex and groundbreaking for a junior ASX listed company, due to the stature of the groups involved in the transaction, as the syndicate is led by CN Docking, a subsidiary of China National Building Materials, a group who produces over 50% of all building materials in China. And whilst this transaction has been a long time in the making, it is worth the wait for investors, given this will see the Chilalo Project essentially fully funded through to the commencement of production. This significantly reduces the requirement for Graphex to complete future capital raisings, meaning the already tight capital structure will remain similar in the future. And whilst this transaction is currently non-binding, there are multiple factors that separate this announcement compared to other non-binding announcements made by similar companies on the ASX, namely the short and specific timing for binding terms to be finalised, the inclusion of a break fee, as well as the commitment by the syndicate to deposit 100 million Hong Kong dollars into a bank account within 10 days. The other major part of this announcement was regarding 50% of the project's production offtake. For any commodity that is not traded on a designated metal exchange, this is probably the most important aspect prior to the commencement of production. Offtake is essential as there are only a limited number of consumers of the product globally. Therefore, the offtake agreement guarantees that a specified amount of production has a guaranteed buyer. We understand the syndicate was prepared to take a greater amount of the project's offtake. However, by selling to a third party outside of the syndicate, there is greater pricing transparency and increased pricing tension, therefore ensuring maximum revenue is achieved for Graphex. The most important aspect for Graphex in the short term is to make this transaction binding. It is likely that once this is achieved, Graphex will have a significant share price re-rating, as the project is largely de-risked, as offtake will be guaranteed and financing essentially completed, which are the two major risks for any graphite development project. We look forward to further announcements regarding the execution of binding terms in the coming months. In addition, this should see the Chilalo Project catapult ahead of other graphite development projects in Tanzania, as it is now likely to become the country's first commercial producing graphite asset.